Hello everyone, this is Padma Pionir Ryuputra. I'm one of the student of Professor Roy from IPMI, and today I'm going to talk about his class basically. I created a mind map explaining about our learning journey and also the key take point that I got from his class. So let's go to the explanation. So this is the mind map that we have for his class. So this mind map mainly the middle part is the corporate finance as the core subject, and we learn about a lot of stuff basically from Professor Roy class, including financial management, time value of money, capital budgeting, investment analysis, capital structure, corporate restructuring, etc. Today I'm going to talk with you one by one here about the specific key point. Let's go to the first part, basically. So the first part that I'm going to talk about is the financial management branch from corporate of finance. So financial management mainly used in the company or corporate world or within our own life with the primary objective of maximizing the shareholder value. Value here is the main word that we need to focus on. And this involves strategic planning and the efficient allocation of resources to achieve long-term profitability and growth. And then under the financial management, there are actually several branches. One of them is good corporate governance, which is a set of rules, practices, or processes by which a company is directed and controlled to ensure transparency, accountability, and fairness in a company's relationship with its stakeholders. And then there is Ramcharan, 5 Business Essentials, which talk about the importance of cash generations, customer satisfaction, cost control, competitive advantage, and also growth, which Ramcharan believe is the main point in which business need to focus on to keep their company keep on going. And under financial management, also we talk about principal agent problem, which occurs where there is a conflict of interest between the management or agents and also the shareholders as the principal or the owner of the companies. So effective governance and incentive structures are necessary to align the interests of managers with those of shareholders. If it's not aligned, that there is a potential of fraud happening, which can be done by the management. That's why the incentive need to be aligned and need to be balanced. Next is the value principle. So the value principle actually refers to the fundamental concept in financial management where every decision are made based on their potential to increase the overall budget or the overall value of the company or the firm. So this principle is central to investment, financing, and also dividend decisions. Lastly is the McKinsey 4 cornerstone, which emphasize the 4 keys area, which is strategy, operation, organization, and also finance. So these are the financial management branch that I learned from corporate finance class. Next is we're going to talk about the time value of money. So the time value of money asserts that a sum of money has greater value now than it will be in the future due to its potential earning capacity. In a simpler term, we can say that $10 today does not equal to $10 tomorrow or next year, basically. Because there is a potential loss of earning that can happen with these time differences. In this concept, we learn about present value, which represent the current worth of a future sum of money or stream of cash flows given a specified rate of return. It is crucial for determining the value of investment. As for future value, is about how the amount of money an investment made today will grow to by a future date, given a certain interest rate. It helps in understanding how much an investment made today can yield in the future, thus aiding in setting financial goals and planning. Annuity is a series of equal payments made at regular intervals over a specified period. Understanding annuities is essential for retirement planning, loan repayment, and other financial products that involves regular payment. Perpetuity refers to an annuity that pays a constant amount indefinitely. This concept is used to value certain types of investment like preferred stocks or perpetuities, which provide a steady stream of income forever. Compound value concepts involves the calculation of interest on both the initial principal and the accumulated interest from previous periods. Compounding can significantly increase the value of investment over time, making it a critical element of long-term investment strategies. I remember in the class, Professor Roy give us some sort of a small quiz. Yeah, he asked like, what do you think about compounding interest between 10 years and 20 years, or maybe only 10 years to 13 years? Apparently, those 3 years gap yield a very, very huge difference because the time frame is longer for 13 years, of course, but the difference is very huge because it's compounding. He also gave another example where the starting or the initial capital is larger and the accumulation will also become a very, very large difference. Next is about capital budgeting. So in the capital budgeting, we talk about capital budgeting itself, which is a critical process in corporate finance that involves evaluating potential major projects or investment to determine their profitability and financial viability. In these sections, we also learn about cash flow, which is net amount of cash being transferred into and out of a business. In capital budgeting, it is essential to estimate the cash flows that a project will generate over its life to assess its profitability. Payback period is the time it takes for an investment to generate cash flow sufficient to recover the initial investment cost. It is a simple measure used to evaluate the risk of a project. Net present value is the sum of the present values of incoming and outgoing cash flows over a period of time. A positive NPV indicates that the projected earning exceeded the anticipated cost, making it a desirable project. While internal rate of return, or IRR, is the discount rate that makes the NPV of all cash flows from particular project equal to zero. It is used to evaluate the attractiveness of a project or investment. A higher IRR indicates a more profitable project. Lastly is the profitability index, which is the ratio of the present value of future cash flows generated by a project to the initial investment cost. It helps in ranking available projects with a PI greater than 1, indicating a good investment. Next is about the investment analysis. So investment analysis is a critical aspect of corporate finance, focusing on evaluating and selecting investment opportunities that will maximize a firm's value. Market sentiment refers to overall attitude of investor towards a particular security or financial market. It is influenced by various factors, including news, economic sports, and market trends. While fundamental analysis is approach evaluate a company's financial health and market position by examining financial statement, management, economic factors, and industry condition. This goal is to determine the intrinsic value of a company stock and assess whether it is over or undervalued. Now, in the fundamental analysis itself, usually we use ratio analysis in examining the financial statements. It involves evaluating financial ratios derived from financial statement to assess a company's performance. Common ratios include liquidity, profitability, solvency, also activity, and leverage. Ratio analysis helps investors and managers make informed decisions about the company's financial health. DuPont's analysis is a method of performance measurement that breaks down return on equity into three components, which is profit margin, asset turnover, and financial leverage. This analysis can help us to understand the factors driving the company's ROE and identifying area for improvement. In class, we did what do you call that? An assignment about this part where we analyze the situation of a company, and the higher ROE does not mean the company is healthy. From DuPont analysis, we found that the cause of the high ROE is actually not a good thing and need to be fixed. So it's very important to analyze the companies fundamental or the financial ratios, not only from one aspect, but from overall view. Next is technical analysis. So this method involves analyzing historical market data, such as price and volume, to forecast future price movements. It relies on charts and other tools to identify patterns and trends that suggest future activity. Beta is a measure of a stock's volatility relative to the overall market. A beta greater than 1 indicates higher volatility, while a beta less than 1 indicates lower volatility, which means that it's what do you call it? Its movement, if it's below 1, is actually less volatile than the market. Or in Indonesia, we use IHSG. IHSG as our market measurement. So we can know like between the companies that we analyze and the market right now, actually which one is more volatile. So it can give us a better insight on whether we need or we can invest in that companies with our situation. And then capital asset pricing model is a model which calculates the expected return on an investment based on its risk relative to the market. It incorporates the risk-free rate and investments beta and the expected market return. CAPM helps in determining a theoretically appropriate required rate of return of asset. And then lastly, weighted average cost of capital represent a firm's average cost of capital from all sources, including debt and equity. It is used to evaluate investment opportunities and make decisions that maximize shareholders' value. Next, we're going to talk about capital structure. So in capital structures, capital structure itself refers to the mix of debt and equity that a company uses to finance its operations and growth. The firm value is a total value of a company calculated by adding the market value of its equity and debt. The capital structure directly impacts firm value by influencing the company's risk and return profile. The optimal capital structure is a best mix of debt and equity and other financial instruments that minimize the company's weighted average cost of capital and maximizes shareholders' value. Achieving this involves balancing the tax advantages of debt with the financial distress costs associated with high leverage. But in class, actually, we learned that the capital structure does not actually affecting the firm value if the market is efficient, if I'm not mistaken. So yeah, although this says that the capital structure impacts firm value, actually the real value of the company itself it's not affected, but it can create perceptions regarding the company itself and create market sentiments, basically, which indirectly affecting the price of the share itself. Next is the corporate restructuring. So corporate restructuring involves reorganizing a company's structures, operations, and finance to improve efficiency and profitability. It can be driven by various factors, including financial distress, changes in market conditions, or strategic shifts. This can take various forms, including mergers and acquisitions, divestitures, spin-offs, or organizational change. Optimal corporate restructuring is caused. One of the reason was financial distress. So the financial distress usually occurs when a company struggles to meet its financial obligation, often leading to restructuring efforts to avoid bankruptcy. Next is the BCG portfolio matrix. So these strategic tools is usually used to help companies analyze their product lines or business unit based on market growth and market share. It guides decisions on where to allocate resources, divest, or invest further. Next is the fraud risk management. So in fraud risk management, we learned that it is a critical component within the broader field of corporate finance, which aim at identifying, assessing, and mitigating fraud risk within an organization. Fraud shenanigans refers to the various deceptive activities and manipulative practice that can occur within a corporation. These activities can range from financial statement fraud, asset misappropriation, to corruptions. And we also learned that there are four types of incentives that drive individuals to commit fraud, which is very essential to learn. These factors include physical, monetary, social, and moral. Addressing these incentives helps in designing effective fraud prevention strategies. Next is fraud hexagon. The fraud hexagon expand on the traditional fraud triangle, which is mainly about pressure, opportunity, and rationalization, by adding three more elements, which is capability, cohesion, and corporate governance weakness. This model provides a more comprehensive framework for understanding the complexities of fraud. Lastly, whistleblowing policy, which is a mechanism in which we can encourage employees to report fraudulent activities without fear of retaliation. So effective whistleblower policies and protections are integral to uncovering fraud early and mitigating its impacts. Now, the last part of my mind map is about wisdom, dividend policy, and also ESG and green finance. So wisdom is actually an abbreviation, WISDOM. It's an important principle that someone who is inspiring to be a successful investor really need to uphold, I think. It consists of watak, impian, ingin, siasat, didik, otak, otot, orang, meter, monitor, and management. Next is the dividends policy. So dividend policy refers to the strategy a company uses to determine the size and pattern of dividend distribution to its shareholder. This policy involves decisions about whether to pay dividends, the amount of the dividend payments, and also the frequency of these payments. In the class, I still remember we talk about we actually debated between us, the students, with Professor Roy. Professor Roy insists that publicly listed company have no need in paying dividends, while we need to insist that the company need to pay the dividend because whatever reason that we can think of. So that was a fun part in the learning itself. Next is the ESG and green finance. So ESG is a framework that helps stakeholders evaluate how a company is managing risks and opportunities related to environmental, social, and also governance aspects. So this has become a very hot topic, especially since the Paris Agreement regarding the ESG, especially the environmental part, where the world need to focus on decarbonization and the government of like almost every countries are pushing the companies within their country to focus on a green project. So green projects are the project that are focusing on helping or boosting the what do you call that the uh, the decarbonization that I mentioned. For example, like using environmental friendly fuel, or they invest on using um, environmental friendly electricity, etc. And green finance is actually one of the tools that are used to incentivize this activity. It refers to financial activities that are designed to ensure a better environmental outcome. This includes financing projects that contribute to environmental sustainability, such as renewable energy projects, energy efficiency initiative, pollution prevention, and sustainable land uses. So that's all from my part. I would like to go back to the first page, basically. So this is the mind map that I created from Professor Roy's class, the corporate finance class. And I hope that my sharing today can help my friend, my colleague, in understanding corporate finance better, and knows what to expect when they want to dive in corporate finance. So I think that's all from me. Again, thank you very much for everyone who's watching. Thank you very much for Professor Roy, my beloved lecturer for this class. Hope I'll have the opportunity to see you all again anytime soon. Thank you very much.